Hey everyone, just a reminder to tell Joe's mom she looks like she lost weight because I accidentally parked on the grass again.
Hey guys, mics are hot. Quiet on the set.
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and with all the talk about tariffs and trade wars and consumer buying slowdowns, how do you effectively hedge against all of this volatility? Whether you're new to investing or a seasoned pro, we'll talk about smoothing out your ride in the stock market on today's show. Plus, we'll help stacker Ryan decide between using a diversified portfolio or a single fund that combines the best of all worlds. Why not just keep investing simple? All that plus our world-famous TikTok Minute and my world-famous Trivia Challenge. And now two guys who are buckled in and more like strapped down to their gurneys, and they're cleared for takeoff. It's Joe and O-G.
I just want to know what airline you've been flying, Doug. Strapped to your gurney and ready for takeoff? Hey, everybody. Welcome to Doug's Weird Airline Fantasy Podcast. I'm Joe Saul-Sehy, Average Joe Money on the Tweeter machine. And man, we are ready to roll on a potpourri episode, OG, because we've got topics and more topics and heck, even more topics. How are you today, my friend?
I am I'm just happy to be here. Thanks for asking. How are you doing today?
I am happy you're here. You and I getting some rain. Like the next 5 days in a row, it's supposed to rain. You building your ark?
You know how people put those little blow up things around their cars? The little hail protectors? I don't know. They probably don't do that in Texarkana, but
What? Nobody does that.
Yeah, they do. Yes, they do. That you put around
It's
your car.
prophylactic, isn't it?
Huh?
It's a prophylactic device.
Oh, could be. But it's for your car, and it goes around the whole thing, and it's like a big not net, but it's like a big blow up thing so the hail doesn't get your car. You guys don't do that?
We don't have them in Texarkana. No, not like there.
We just invented these things up in the north called garages.
We have those too, but when your garage is only a 3-car garage, what are you going to do with your 4th car?
So good. So good.
I mean, what you got to pick, Mercedes or McLaren? Which one's getting protected today?
The high school kid's Land Rover gets to stay outside.
Yeah.
I mean, that's always is the challenge, right? You're like, okay, and then what?
What are you doing with the Porsche?
And Navy Federal is going to hit you with a higher insurance cost, because you got a hail claim,
Those insurance costs get you every time, Doug. Get you every time.
Damn right they get me.
We got a great show. We are already rolling, starting off, poking each other. It's going to be great. You get a full hour of this, everybody. But to kick things off, we're going to start off with a fantastic headline about ways some experts are talking about you smoothing out the ride in the stock market. But before we shine a light on that for you, we got a couple of sponsors who make sure this is free for you so you don't have to pay a dime for any of this goodness. And we're going to hear from them and then into today's headline.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's headlines.
Our headline today comes to us from the Wall Street Journal. Last week on Wednesday afternoon, the White House announced even more sweeping tariffs. John Cindro wrote this piece in the Wall Street Journal. Don't blame Trump for all the stock market's problems. Of course, we've had in response to the tariffs and also lots of other factors. We have had a stock market that has trended lower, to put it mildly, the past couple months. John writes this, OG, with the S&P 500 having suffered a correction in the word, quote, recession being uttered across Wall Street, it's tempting to link the fate of the stock market to the Trump trade war. But investors shouldn't forget that danger can come from many directions. That last sentence that Cindro wrote, I really, really, really like, because here's what happens. We get focused on one lever, right? We get focused on one thing. And one of the things that really historically have happened in my 30 plus years doing this, you're going on 30 years doing this.
That's a long time.
The things that really affect the market, OG, come out of the blue sometimes, right? They are things that you didn't expect. Some of the black swan events that happen, or this thing happened, or it's a conglomeration of 50 million things that occur. And sure, we've got this easy tariff stuff right in front of us, but I love what Sindro's implying here. Don't get so myopic that you're just focused on one thing and you forget danger's always lurking when you're an investor around every corner.
I take issue with this whole concept altogether. And to be clear, we're not trying to make a political argument one way or the other here. This is not like, it's not that bad, trust us, guys.
No,
we're not like saying,
no.
it's not, it has nothing to do with the politics of this.
And also, OG, to be clear, the day before this piece came out last week, the Wall Street Journal had another piece come out saying, because this obviously sounds pro-Trump from the beginning of the piece.
Yeah, that's what I'm saying. It's like we don't have a dog in that.
Yeah, Wall Street Journal had a piece the day before that said that Trump's tariffs are like a $36 trillion tax levied on the American public. So they called the tariff a tax. So even the Wall Street Journal, I don't think is being political here.
Yeah. Well, so here's the thing. I was listening to what the opening was here, and you said there's danger lurking everywhere. And I think that's an awful way to look at investing.
I think it's a great way to look at investing.
No way. None of this is dangerous. This is completely normal. If you look at the stock market and go, oh my God, there's danger around every corner. You're never going to do anything. Why would you? If Doug's going out to chop trees down in his yard because of the ice storm from 2 weeks ago, and he's like, oh my gosh, there's danger around every corner, he might not do it. Investing is not dangerous. There's nothing dangerous about it. Danger is not investing. It has nothing to do with tariffs or the market going up or going down or sideways. This is all short-term. Who gives a crap? If you're investing in the stock market right now, or you've been investing for the last year, 5 years, 10 years, 30 years, whatever, your time horizon has to be 10 years plus. If you're an idiot and you're putting money in stocks right now that you need a year from now or 2 years from now, that's being stupid. That's not being dangerous. That's just being dumb. Don't do that kind of crap. But if you're investing for the future, none of this matters and none of it's dangerous. The only thing dangerous is not investing because you're worried about the tariffs or whatever else chaos theory the stupid Wall Street Journal wants to put out there and scare the hell out of you. I
mean, this might be semantics, but if you are investing for a year out, the market is dangerous. It is dangerous, and it will take away your money with a 1 year time frame. And listen, Doug's staying inside of his house. If there's trees across his driveway and there's the chance that ice might hit him on the head, him staying in his house forever
ice might hit him on the head.
Well, there's the short term and obvious and the long term and not so obvious, right? If we focus on the short term and obvious, quote, danger, then we're never going to freaking do anything. But the problem is that the prescription in this case of doing nothing hurts the patient, which is, I think, 100% my point. Once you
realize zero danger to investing,
100% there's danger and there's risk. If you invest in a penny stock, that stock could go to zero. Heck, if you invest in a stock that's even trading today for $100 a share, that stock could go to zero. That is a real and present danger with the stock market. What you're talking about is getting thoughtful about it. And how do you get thoughtful about the stock market? You actually take into account all the shit that could go wrong, and you guard against those things. You guard against those dangers. So you've got two options when it comes to investing in the stock market. Number one, don't do it. Well, what happens then? Let's go to that outcome, right? Which is your point. Or outcome number two is, if I recognize that, what am I going to do? Number one, I'm going to get diversified. There's a way to avert the danger. Number two is, I'm going to think not about 1 year or 2 years or what's going on with the trade war. I'm going to think in 10, 20, 15, 30-year increments. That's averting the danger. It's not dangerous. It is it is dangerous. And once you realize that it's dangerous, and then you start figuring out how you're going to play that game in a way that gives you the outcome that you need to get where you want to go, then I think you're a kick-ass investor. So I couldn't disagree more, man. It's dangerous as all get out.
I can tell. You're all fired up.
Man, why are you yelling at us, man?
I know.
Well, because it's stupid.
He's still yelling.
It's so stupid.
Well, I wouldn't call my comments
It's not
stupid.
dangerous. Yeah, it's dangerous.
Whoa.
No. This is part of the problem with people who say things like, I can't invest in the stock market. It's too risky, because they're afraid of the boogeyman that doesn't exist.
That boogeyman does
There
exist.
is no boogeyman.
That boogeyman does exist.
If you want to pick on a specific thing, like if I buy penny stocks, I could go broke. Well, yeah, no kidding. When I say investing, I'm talking about if you're putting $100 a month or a week or a day or whatever your thing is into the S&P 500, if you're putting $100 a month into the international markets, if you're putting $100 a month into small cap, and I'm talking about the big broad brushstroke of investing, not a particular thing. Yes, you could die penniless if you put all your money in Apple, or you could be a billionaire. I don't know what's going to happen.
But that is broad brushstroke. Broad brushstroke of investing is this is a stock in the stock market.
If you put your money in a mutual fund or an ETF that is broadly diversified, there is zero concern.
Joe, the example you immediately went to get yourself all worked up was picking an individual stock. Nobody's ever said that.
No, what he went to was getting away from the danger by doing something that, because he's educated in this area, he knows how to do. That's what he did.
I'm saying,
so focusing on,
I talk to a normal person on the street and I say to them, why are you not invested in the market right now? People will reply with the general phrase of it's risky.
It's risky. And why do they think it's risky?
Because of stupid pieces like this Wall Street Journal article that say, don't invest in the market right now because of tariffs, or do invest because it's tariffs, but know your scary monster. There is absolutely nothing risky about owning the economy of the United States for the next 30 years.
Why do people think that way?
Not a
why do people
of this nonsense? Because of this article of people going, it's so scary. It's dangerous.
So are you saying
you got to be careful with the danger around the corner? Are you
saying, because I think what I hear you saying is, if we don't get educated on this and we don't understand that this is irrelevant, this whole thing, and if we take a long-term approach, then we don't have to be worried at all.
Why not have a Wall Street Journal article?
How do we get that way?
Why not have a Wall Street Journal article that says investing is never dangerous when you're diversified and you have a 20-year time horizon?
You put a caveat on it. I love it. He puts a caveat on it. When you're diversified and if you have a 20-year time horizon. And how do we understand that, OG?
I said at the very beginning that if you're investing in the stock market today for money you need tomorrow, that's stupid. It's not dangerous. It's stupid. It may turn into be a good decision. Driving 100 miles an hour down the highway is stupid. You may get there faster, or you may end up in a burning heap of molten metal. I mean, I don't know what's going to happen
because it's dangerous.
The same thing. Well, I would submit to the court that driving 100 miles an hour down the interstate is dangerous. Yes, I would capitulate to that. But investing in the stock market is not dangerous. I don't care. You have your opinion. You're very committed to it. And also I'm committed to mine. Next topic, Your Honor.
I think you're committed to it because you've already mitigated the risk. You've already mitigated the risk. In your head, you've mitigated the risk. But the reason we have this podcast is to help people mitigate that risk and to learn how to avert the danger.
I would mitigate
of the stock market
by saying that there is none. If you start with the premise that there is none, there is no danger, then you're more likely to go down that path. If you start with the premise of it's dangerous unless you follow all these specific rules, then it's like, well, I don't know. It still sounds dangerous.
You already had those rules.
I'm just saying.
You just put those rules in place.
Tell people it's not dangerous. Let's just start by saying investing is a smart thing to do and it's not dangerous and everybody should do it.
Well, how about this one? Well, then if it's not if it's not dangerous and it's really easy, let's go to this headline. This headline from Investment News. Goldman Sachs. I mean, there's a smart company with people that I should pay attention to. Goldman Sachs Group Incorporated expects the yen to climb to the low 140 levels against the dollar this year as jitters around U.S. growth and trade in a totally not dangerous market bolster demand for the safest assets. I added not dangerous, by the way.
We got that part.
The yen offers investors the best currency hedge should the chances of a U.S. recession increase, says Kamakshia.
Says some guy at Goldman Sachs or gal. One of the
Kamakshia Trivedi. I'm sorry, Kamakshia.
Spell it.
Oh,
spell that.
Can you use it in a sentence, please?
Kamakshya. Whoa, head of global foreign exchange, interest rates, and emerging market strategies.
That person.
The yen tends to do best when U.S. real rates and U.S. equities are falling together. Trivedi said in an interview in New York, Japan's currency screens as a more attractive hedge for the downside view on U.S. growth than it has done for some time. What we led with was that Goldman Sachs, very smart people, says that if you just buy some yen, then we're good to go.
Okay. Should I invest in foreign companies? Absolutely. Yeah.
Not
scary at all.
Not foreign companies. I'm talking about foreign exchange, the Forex. Buy some yen. Go buy some yen.
Okay. I mean, that's pretty concentrated. I wouldn't do that. That seems a little silly, but
why wouldn't you do that? Why? Just wondering why you wouldn't do that.
It's not. I mean, it's not smart. Why would you?
Why is it not smart? Just avoid the word. Just go ahead and avoid the word.
You want me to say that it's dangerous? Is that what you want me to say?
I think this advice is hella dangerous. It's horrible advice. Do you know anything about the yen? Does our average stacker know anything about the yen? They don't know anything about the Japanese
on my keyboard,
yen.
It's a Y with 2 lines on it.
That's all you need to know. That's all we need to know. Hedging.
That's not investing.
Hedging against down
it's
markets.
Speculation. It's not investing. It's not investing. It's speculating. Different thing.
Which you learned how?
Hedging transactions have a net outcome of 0. That's not investing. That's speculation.
I think this idea, Doug, we mentioned at the open that we were going to tell you how to smooth out the stock market. This is how Goldman Sachs says you smooth that out.
You just smooth Joe out is what we need to do.
Yeah.
I don't know why you need to smooth.
Joe needs a mood leveler.
No.
I do not understand why I'm playing the villain in your show. I do not understand.
I don't understand why you're playing villain in your own show, but that's usually my job. But I'm letting you roll with it, buddy.
Wow.
Good cop, bad cop. We switched roles all of a sudden, and it's kind of nice over here. It's warm and fuzzy and, feels nice.
I think the way that you smooth it out is exactly what you were saying earlier. Get a 30-year horizon. Get a 20-year horizon.
Don't be dangerous.
Just
don't be dangerous.
Don't think about the short-term volatility. Stay diversified and don't think about that. I think that's the way to mitigate against the danger in the market.
Yeah.
The danger in the market is that you're going to play it day to day. That's the danger in the market.
Stupidity.
Is that you're going to play the day-to-day game. You're going to play the tariff game. You're going to play the how do I smooth it out? Why am I trying to smooth out a market when volatility is my best friend?
It always goes up. Yeah, there's no danger. There's no downside.
That's what you said.
Yeah, there's no danger.
What's going on here, Doug?
There's no danger in long-term money.
Amen.
Is what I think we're all trying to say here.
Amen.
Right? But
By
don't
all of us,
invest your
it means
2-year
me.
money in yen.
Please, God, do not try to smooth out the market. If you don't need this money for 20 years, why are you trying to smooth it out? Why are you trying to make your ride smoother? I think it's a better idea. I think it's a much better idea to realize there's going to be bumps in the road. And I love this idea that they can come from anywhere. Back to Sidro and the Wall Street Journal piece, OG. The fact that those bumps can come from anywhere at any time, and knowing they can come from anywhere at any time makes it a more comfortable
less
ride.
dangerous.
It doesn't make it less dangerous. It makes it equally as dangerous. But think about this. This is actually interesting when it comes to fear, when it comes to people's fears. And I've used this analogy before. If the plane starts bouncing around with turbulence, and the pilot doesn't come on and tell me there's going to be turbulence, right? Then I start freaking out. I think there's a bunch of stuff happening up there. I think there's like smoke coming from the consoles. The pilots are screaming, we're going down. If the pilot comes on ahead of time.
That's what you
think?
think?
If the pilot comes on, yes, 100%.
That's immediately where your mind goes.
Wow.
Oh my God, he didn't say anything. We're all dead.
Yeah, when you've got this very turbulent plane, 100%. Yeah. Do I get nervous when I fly? Hell yeah, I get nervous. But when the pilot comes on ahead of time and tells me, you know what, this is going to be a bumpy flight. There's no danger. We called ahead. We know exactly what there is. If you just sit in your seats with your seatbelt fastened, things are going to be just fine.
No danger at all.
It's going to be
totally normal.
It's going to be just fine.
It's not going to be dangerous.
So then
Joe has for those of you not looking on YouTube right now, Joe has the I'm going to reach across the table and punch you in the throat look. He's about that close.
So then I have two choices, OG. Choice one is I don't make the flight, which is what you're talking about. The stock market is dangerous, so I'm not going to invest. Okay.
I think there's a lot of people who think that. Yeah, I do.
Right. And what's that outcome? If you follow that outcome to the very end,
you have to walk.
Yeah. And think about it, you're never going to reach your goal.
Never going to.
You're 100% never.
Very dangerous.
It's fine. You can do that. You can go, you know what? I don't get in a plane. Then there's not a chance of a plane crash. There's not a chance that my seatbelt's unbuckled.
But you might get attacked by a wolf instead on your hike to Orlando with your family.
Which is interesting because there is danger in the thing that you choose, right? I mean, Stephen Covey talks about you pick up one end of the stick, the other comes with it. If you decide I'm walking, you think there's no danger there. There's a ton of danger there. Like there's a bunch of danger there. Yeah. So I think that fully analyzing what the danger would be and then going from there. And this idea, Goldman favoring yen to hedge against volatility, just absolutely incredibly ridiculous. We'll dive more into volatility and into all the different risks because I think there's a ton of different risks in your portfolio. And when we focus just on one, tariffs are going to get me. I think we're in big trouble. StackingBenjamins.com/201 to sign up for the 201. Time for our TikTok minute. This is the part of the show where we shine a light on a TikTok creator who's either doing something brilliant or air quotes brilliant. OG, you think we're going to hear brilliance right now or some maybe air quotes?
I'm so scared to answer. I'm going to say air quotes.
We're talking on Monday about Seth Rogen and having too much money. I think this is a nice follow-up. This is one of my favorite comedians. Doug, I think you like this guy too, Jimmy Carr.
Oh, yeah.
This is Jimmy Carr, but not being funny, just talking about his career and how he became a comedian.
I didn't leave my job to be rich and famous on TV. I left my job for, yo ho ho, a pirate's life for me. We're doing comedy. I'm doing a gig above a pub. Someone gave me £20 cash in hand. It was crazy. I'd had like a good job. But it's that thing where you go, the good is the enemy of the best. How much to not live your life? How much to not follow your dreams? How much do I have to give you across the table? Now, I'm saying this to you now, right? You're a wealthy man, you're an investor or whatever, so it's going to be a high figure. But for most people in their mid-20s, they've just left college, or early 20s, they've left college. And you go, they give you 35 grand to compromise on everything and always be tired and just work to my time. And people go, okay. That's the thing of like working for someone else is, I think, that's the big shift, right? So my stand-up is a metaphor in the book. I'm not trying to get people to become stand-ups. Frankly, I don't need the fucking competition. But the idea of going and doing your thing, even if it's less successful, but doing your thing, being your boss, being your CEO, great. Like, I'm all about that. When people tell me they've started a little business or done a little thing, you just go, yeah.
I love this idea that Jimmy brings up again of trading money for time. Like how much money is it going to take, OG, for you to give up on that thing that's a 10 and instead go, you know what? I'll do the 7. I'll do the 6.
I like this quote, yo ho ho and a pirate's life for me.
I do too.
Yeah.
You know, it's funny because it's not the 2s and 3s in our life that we can easily identify that are the thorns because we get rid of those in a hurry, right? It's the 6s and the 7s where it's like, yeah, it's okay. Yeah, right. You know what? It's okay. Those, I think, are the problem points for a lot of us in our life. And I don't know if it's necessarily working for somebody else that's the issue. It's actually designing your own curriculum, right? Designing your own life. Good stuff from Jimmy Carr. By the way, thanks to Julie for sending that to us. If you've got a TikTok you'd like us to watch, it's pretty inspiring. Usually people send me funny ones. That one was pretty inspiring, Julie. Joe at StackingBenjamins.com for that. Coming up in the second half, we are going to help a stacker in need diversify his portfolio. Sources say, oh, gee, there's a bunch of danger in the stock market. So
I guess we'll see.
We're going to see if we can help him out, help a stacker in need. But first, Doug, you've got some trivia for us today. What's on tap in this day in history?
Hey there, stackers. I'm Joe's mom's neighbor, Doug, and Houston has been home to a ton of interesting fun, including back on this date, April 9th, 1965, when the Astrodome opened. There's fun thing number 1. And then, as if that wasn't enough, Mickey Mantle, he went ahead and hit a home run in an exhibition game between the Astros and the Yankees the day it opened. Are you kidding me? I asked Joe's mom if she ever made the trip down I-49 to the Astrodome, and she said she would never go into a filthy place like that. I'm like, filthy? Mom, what are you talking about? She's like, yeah, the Astrodome.
Oh, no.
Hard pass. She said it. She said it. So after I clarified that Astros referred to astronauts, another term she had completely misconstrued, I also shared that even further back in 1959, NASA picked their first astronauts today, on today's date, April 9th, most going on to amazing achievements, well-deserved fame, and piles of Benjamins. But here's today's question. Collectively, as a group, en toto, what did NASA call these first 7 astronauts? I'll be back right after I go study the planets. Joe's mom keeps asking about Uranus, which she also doesn't fully grasp as an orbiting body. Hey there, stackers. I'm Uranus observer and guy who loves astrology.
No.
Did I say it wrong? Joe's mom's neighbor, Doug. The 7 astronauts selected by NASA on today's date back in 1959, why are you making me laugh, are nearly all household names. While sadly, Gus Grissom died when Apollo 1 caught fire, the other 6 achieved amazing feats. Here's a sample. Alan Shepard became the first American in space in 1961 and the 5th man to walk on the moon, 1971. John Glenn became the first American to orbit the Earth in 1962. And oh yeah, a senator. And Gordon Cooper was the first American to spend an entire day in space and the first to sleep in space. Or at least the first one to admit he fell asleep in space. Imagine sleeping in space! And to think someday we'll even be able to send probes to Mars. But we did that? Huh. All right. Well, today's question collectively was, what did we call these first 7 astronauts? They were the Mercury 7, because why not? And now back to the 2 rocket drivers operating this podcast surgery thing.
Oh, inside joke for the win, OG, right there. Rocket drivers.
Mm-hmm.
Why?
Rocket drivers. A little shout out to our good friend Frank Bologna for that. You think Frank's a fan of the show?
Maybe.
Yes.
He should be.
Yes. Frank was the person that called them rocket drivers, Doug, a long, long time ago.
Okay. Thanks, Frank.
Not even being facetious. Was like, doesn't take a rocket driver to figure that out. Frank did not know that was rocket scientist. Could have been. Hey, let's help a stacker in need. Time to help out a stacker who said, you know what, I better call Saul-Sehy and OG. This is the part of the show where we help out a stacker. If you would like us to help you, it's stackingbenjamins.com/voicemail gets you front and center, and you can be every bit as cool as
Cucumber.
Doug.
Oh. The other side of the pillow.
And Ryan.
Hey, Joe and OG, this is Ryan from Tennessee. I really appreciate your take on personal finance investing. Joe has talked about the efficient frontier on multiple occasions in the last few months. I know he's also mentioned having holdings with Dimensional Fund Advisors. I'm drawn towards Dimensional's philosophy of factor tilts towards small cap, value, and profitability based on the Fama French 5-factor model. I'm also drawn to the idea of an all-in-one fund portfolio for simplicity. Dimensional's World Equity ETF symbol DFAW is a fund of funds. It's well diversified with approximately 12,000 companies across 45 countries, and it holds mild factor tilts towards small, value, and straining companies based on profitability, all with an expense ratio of 0.25%. Its portfolio is roughly 72% US, 18% international developed, 8% emerging markets, and 2% REITs. Avantis Investors has a similar global equity ETF, ticker symbol AVGE, which is slightly more value-y and lends towards smaller capitalization than DFAW. What is your opinion of an all-in-one fund portfolio like DFAW or AVGE, which covers multiple asset classes already, as a simplified substitute to the efficient frontier portfolio made of multiple holdings? Thanks.
Hey, Ryan, thank you so much for the question. First of all, let's kind of help out people that don't have any clue what Ryan's talking about here. Let's begin, OG, with this idea of dimensional funds. And he talks about FAMA and French. So what is it that Dimensional is doing as a fund company that Ryan wants more of?
Yeah, so Dimensional is a fund manufacturer, just like you would use Vanguard in a sentence and say, I have a Vanguard fund, or I have an iShares, or I have a Fidelity fund. Dimensional is an investment company. Avantis is another company you mentioned. They're part of American Century. They're a fund company also. So as a matter of fact, I was just looking this up to try to find it. They just put out a full-length movie. I don't know, is it a full feature film, an hour long, 2 hours maybe, documentary of how Dimensional started. But the long and the short of it is they, as well as Avantis, are very focused on the academic piece of investing. A lot of the academic research that's come out of investing and different Nobel-winning investing theory people have gone on to work with or consult with Dimensional, and so a lot of their investing behavior is kind of focused on that. It looks like you've got the name of it, Joe. What was the name?
I do. It's called Tune Out the Noise, and it's an Errol Morris film.
Yeah. And it's on YouTube. You can find it for free. So it's great. Tune Out the Noise. And so a lot of academic research has gone into Dimensional. I'm sure that's true for lots of companies. Dimensional kind of leans on it quite a bit. And one of the things that they've really focused on is what's called the FAMA French 3-factor model. And that was really kind of put out in the 70s and then formalized in the 90s. The idea being that there's areas of the market that exhibit higher expected returns, and those areas are stocks do better than bonds, value companies do better than growth companies, and small companies do better than big. And now they are working on profitable companies do better than unprofitable. Shocking.
Rocket science.
Took them this long to get to that?
Blinding flash of the obvious. Well, the way that I think about it is that makes sense to us, but the nerds at the nerdery are trying to prove it mathematically. So for them, the way that they think about these different factors or these different areas of the market is it has to transcend location and time. So it's not just, well, yeah, value did great in the US from 1970 to 1974. So therefore, no, it does good all the time in all market cycles, in all market conditions across the globe. You can imagine it's pretty difficult to kind of posit this theory and then let it get blown up by a bunch of other academic people until they get to the point where somebody goes, yes, we can prove mathematically that profitable companies do better than profitable ones, despite the fact that we go, yeah, I could have told you that. Give me the Nobel Prize. I should know. Or stocks do better than bonds, right? It's like, we know that, but we know it because we have the history. What the math people are trying to do is to prove it, focus on investing.
And by the way, just as I'm reading down through this piece, OG, there's a quote from Paul Merriman, who people may know on this show because we talk about Paul quite a bit.
Yeah.
He and his team do a bunch of research, and he talks about all the research that he's done is based on research that he originally found from Dimensional. Like he started with the research that Dimensional's been doing and then just expanded it from there. So even Paul is pointing at the Dimensional nerdery, as you put it, saying, hey, these guys are really into the science of why.
And David Booth would tell you, so he was the founder of Dimensional, or one of the co-founders of Dimensional, and he would tell you luck played a lot into this for him because he happened to be at the University of Chicago when all of these finance guys were there, all doing this research all at the same time. And so a different person at a different college or a different, all of this may not have transpired. But if you look at their board, it's just packed with Nobel laureates. In any event, so Dimensional has this theory that if you create an index portfolio, but then do some tilts, that's what they call it, some tilts toward these factors of smaller value, profitability, that you're going to get a smidge higher expected return. They seem to be right, but tomorrow's not promised to everybody, so we'll see what happens in the future. Avantis is another company that does this, interestingly enough, started by some members of the original Dimensional team. So I'm not privy to that whole story, but maybe there is some sort of breakup and all of a sudden, now there's two companies that do it. So very similar. Avantis tends to lean more heavily into the factor tilts than Dimensional does. They're going to be a little bit more tilty, if that makes sense. So what Ryan's talking about here is if he believes the Dimensional guys, right? And he says, hey, I like this line of thinking. This makes sense to me. I support this research, or I support the fact that they've done the research. And I believe this story, We happen to also, by the way, we heavily invest in dimensional Avantis. Can I skip to the end and just have one fund that does it all? Do I have to have a small cap fund and a large cap and a international and emerging markets and that sort of thing? Or can I combine that into one? Whether it's a dimensional one, Avantis one, or, other places have factor tilt models too. And the answer is, yeah, you can do one. Why do you have to complicate it? There's some benefits to having multiple funds. And one of the benefits would be rebalancing, potentially, capital gains, capital loss harvesting. There's some tax benefits to being able to trade and rebalance and that sort of thing, depending on how those positions are behaving. However, if this is an IRA or a Roth IRA, and you're like, I just need one that gets me home, there's a lot worse you can do than complicate your life of having 15 different ETFs in your Roth IRA. So the short answer to all of this is, yeah, that's a fine option. There's, whether it's the fund that he selected or one of the funds that he selected or a different variation of it. It's all equities, so just be aware of that. There's no fixed income in those portfolios, so you have to account for the fact that there's going to be some pretty wild bouncing arounds, if that makes sense. So if you need some fixed income or if you need some cash in your portfolio, you'd have to buy that separately.
I definitely like both of these better than a target date fund. It's not trying to, quote, land the plane. They're not trying to guess what your goals are. Like you, I certainly have an appreciation for having your own asset allocation. I also think that it's a little stickier when you know why you're in the individual funds, because I do think, with my earlier diatribe about risk, I think the risk is that you don't understand what you're doing. That, to me, is a danger in your portfolio, is that I don't get why I'm here. And so I just want to keep it easy, in quotes. And so then the plane starts doing weird stuff. And now I'm just, grabbing my parachute and wrecking my own strategy. That's why I kind of like building it. But certainly, listen, I don't think it needs to be complicated. 3, 4 funds. It doesn't have to be 85 funds. And, I've got one little string for everything.
Yeah. And I'm pointing out one thing that you said that I forgot to mention. This is different than a target date fund, because I think some people might hear this and go, wait a second, fund of funds. I thought, whoa. OG's been raging against the machine for that for 20 years. Like, what is going on? So the difference between a target date fund and this, there's some similarities. One similarity is it's a fund of funds. So the fund he mentioned has 5 different ETFs inside of it to make one ETF. So you can go buy those 5, or you can just have one, right? If you want that asset allocation that they provide. That's the same in a target date fund and in this. The difference is a target date fund will say, oh, you're 20 years from retirement, you need to be more conservative. You're 15 years from retirement, you need to be more conservative. You're 10. It's going to your point, you're say land the plane. It's going to continue to get more conservative as you approach the target date of the fund. If you buy a 2040 fund, as you get closer to 2040, you get more and more conservative. This is a static allocation. So it's not going to change in so much as being more conservative. It might change in terms of what dimensional wants the allocation to be, but it's not going to say like, oh, there's not an end date for this fund, if that makes sense.
Yeah.
This is the allocation. This is what we're going to go with.
For that reason, I like it a lot better as well than a target date fund.
Compared to a target date fund. Yeah. Not the same.
Good stuff. Ryan, thank you so much for the question. If you've got a question for us, bring it, man. It's stackingbenjamins.com/voicemail gets you on, and OG can explain, what's going on here. Why would we have one fund, and why do we think differently about this than a target date fund? Because we definitely do. All right. That is it, except for, Doug, I think we've got...
Yeah.
We got a letter. We got a letter on the back porch.
We do. Yeah. We got a letter from a listener. And if Michelle had just, been brave enough to call in, she could have gotten a t-shirt for this. It's a great letter. She makes some great suggestions or has some great questions. And if we could have heard her amazing voice, she would have gotten a t-shirt out of the deal. But alas, she doesn't. There's another thing I just need to preface this with, but I had to read between the lines a little bit on this letter, because she's saying some things in here that she didn't actually type out, but I sort of, after reading it a few times, I figured it out. So here we go. She says, "Hi, Joe. I've been listening to the show since 2020. It's one of the only podcasts I subscribe to. I love it and have learned so much.
Oh, that's nice.
from Doug.
Yeah. Oh, I didn't see that in there.
That was one of those things. Like after I read the whole thing,
Implied.
and it was implied when I I did the grammatical math for how she put the whole letter together. I realized that's really what she was trying to say. I'd like to make 2 episode suggestions for the Wednesday episodes with you and OG. And then she says, again, between the lines, the boring parts when Doug's not talking. She says, 1, a deep dive into everything you consider for an emergency fund. You've consistently talked about 3 to 6 months of living expenses, but OG recently mentioned he had raised their home insurance deductible and would cover roof replacement and some other expenses out of pocket. That got me thinking, what else should be included in an emergency fund / cash reserve? Sounds like it could be a large amount of cash. So do you keep it all in cash, or like 50% in cash and 50 in treasuries, since you most likely won't need the entire fund at the same time? That's all question 1. And then question 2 was, could you have an episode about financial retirement planning for a single person? Is it the same as for couples, or are there some differences? A lot of examples on the show are about couples, and as a single person, I sometimes wonder if everything applies to me, like term life insurance, in parentheses, this time she just spells it out. She didn't make me read between the lines. No kids, or specifics around retirement. Keep up the great work. Let's have more Doug. Thanks, Michelle.
Didn't read that in the letter either, but of course implied.
She was just,
implied.
Helping her out.
Michelle, those are fantastic. By the way, we also in the Basement Facebook group had some people that wanted more on crypto and also wanted more on infinite banking, wanted to know how those those things work. Well, here's what I like. I mean, we've been doing these deep dive episodes with Barry Ritholtz, with Molly Fletcher. We're going to do another one next week with Kevin Evers from the Harvard Business Review on the strategic genius of Taylor Swift. We're going to do a full week on everything. I mean, from managing your career, which we could all be better at, to managing your money, diversification, all these different things that we lump into financial planning or career, but really round out just having more Benjamins. But all these happened on Barry Ritholtz's week when he was talking about how not to invest. And I love, Doug, that it got people really excited about, hey, can we talk about this one? Can we talk about this one? That is exactly what we want with these deep dives. Like, how do I go get more? And man, if you want to write to me and find out where to get some of this goodness, because we can't cover everything, like infinite banking, we won't be covering on the show, I'm happy to point out places to learn more about why you don't want to do it.
Well, something we could consider putting together, Joe, is like a weekly newsletter that goes deeper in depth.
If only we had a weekly newsletter that did it.
Actually, think about making one of those.
Actually, that is interesting about kind of refocusing Kevin's work around like infinite banking. How does infinite banking work, or how does, whatever that thing might be. But I do love, OG, the idea of, emergency funds are ubiquitous enough that I would love on one of these episodes to tackle good and bad in your emergency fund. And that'll include insurances, right? Because emergency fund and insurance is kind of all together. So Michelle, game on that one. Give us a few weeks. We work on a 5-week schedule, so we're on that one. In terms of, Doug.
Oh, I was just gonna say, I liked her second question also about single retirement planning for single people, because we don't talk about that enough. I think because all of us are less than single, we probably don't think about that.
Well, and and that's the danger point, right? I mean, the danger point for us is using analogies that have to do with, Cheryl and I, Mrs. OG, whatever.
Idiot kids.
Those wild kids. And that's something that we need to be more mindful of. I don't want to do episodes that are just for married people. And I don't want to do episodes that are just for single people. I want to do episodes that we can all learn from, but making sure that we're looping everybody in, including everything. Because as an example, Michelle, when it comes to insurances, the reason you have insurance, 99% of the time, the reason you have insurance, OG, is to protect the people that are left when you pass away. So to Michelle's point, if she's single and nobody's relying on her for this money coming in, there's not an insurance need.
I think it's good feedback, and we'll just have to be a little bit more mindful of the fact that, using our anecdotal stories are helpful to a lot of people, but then also maybe just throw in a little bit about if you're this type of person or if you're this type of person.
We could go back. You've got some amazing stories from when you were in the service when you were single, OG, that are
I don't think we want to hear those. Okay, on
no.
that note,
Scratch
thank
that.
you for the note,
For the
Michelle.
record, I was never single in the service. Mrs. OG would tell you that. There was never a single time in the
And you
service.
still did those things? Oh my God.
Oh, man. Oh, boy.
He's kidding, everyone. I'm a trustworthy young man.
How come you don't come at him like you came at me? Why would you
I
just
have
let
my
that
honor, Your Honor.
Just don't know.
Wow.
Because I have as many skeletons of Doug's in the closet that I can reveal. He knows it's like, the concept where we both have nuclear arms
Yes.
pointed at each other in Russia.
Mutual destruction.
Oh, geez, like, you want to go here? Do you really want to
Like,
go
we
here?
can play this game if you want. It's going to end badly for both. Moscow and DC are annihilated.
How far down this rabbit hole do you want to go? Yeah.
I'm going to go for a walk, fellas. What do you think about that plan?
Going for a walk?
Yeah. Are we, I feel like we're wrapping it up.
I think we
thought
are.
I'd let you know what I'm going to do next.
Well, and that's exactly, what I want to say before it starts raining, right?
Yeah.
Doug, what should we have learned on today's show?
Well, Joe, first, take some advice from our headline. You should always expect downturns in the market. Hedging against it, that'll go sideways in a hurry.
Just to be clear, because there's tons of danger, Doug.
It's so dangerous. Unless you can predict the future. And here's a tip, you can't. Second, choosing the one-size-fits-all fund? Maybe, but it's always better to begin with the end in mind and choose funds based on your goal, not on ease of management. But is a single-dimensional or Avantis fund a good idea? It can be. But the big lesson? Don't ask Joe's mom who her favorite astronaut is. She'll share a story about my favorite pair of chaps that we'd have to delete from this podcast. It's a family show, Ma. How many times do I have to tell you?
Oh.
This show is the property of SB Podcasts, LLC, copyright 2025, and is created by Joe Saul-Sehy. Joe gets help from a few of our neighborhood friends. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. Oh yeah, and before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show.
Welcome to the after show. Man, I'm looking at the after show agenda, guys. This is going to be a packed
Rapid
one.
fire.
Yeah, well, let's start off because you two guys have been playing. We haven't talked about video games in a while. Doug, you and our friend Eric have been playing some golf lately, and you guys have been schooling. You guys basically kicking my ass.
Yeah,
on the golf
that's why
course.
it's so fun.
Yes,
I love playing that. It's a great social game to play because you can have a great conversation. You know, there's enough action to keep you occupied and focused on the game, but really you can just hang out and talk.
That's really all we're doing, sharing what's going on with our families and our lives.
Eric and I have a great time, and you're there too.
You guys are there to. It's funny because after 9 holes, I'm losing so bad. We play skins, which means you try to win the hole. And
I was naked.
And
Am I not supposed to be?
I was just going to say that's a different game that Doug plays.
Oh.
I thought skins referred to. Oh, my bad.
Doug's like, I lose again.
Stop it, boys.
The holes become worth more and more as you push on a hole as people tie. But after 9 holes, I always, both times we've done that, Doug, I've gone, okay, 9 holes in, I'm not winning. I should probably go get more to drink because that's going to help.
Yes. That's when the words start slurring.
Yes.
So we've had a great time playing that. And then
You and OG have played some Sniper Elite.
Sniper Elite came out with a stopgap called Sniper Elite Resistance. And it's a stopgap because Sniper Elite 6 is taking so long to get developed that there was a lot of demand in the marketplace for something new. So they farmed out to some other publishing company, development studio.
Like the IP?
I guess it's almost like, and they gave him the engine and, and all the other stuff, but they farmed out the level design and a little bit of the story. And it's really just Sniper Elite 5 with I think it's 6 new maps. Is that right, OG? Something like that.
No, I mean, there's a lot of similarities. I know that there's when you play again, you're like, this feels a lot like something from the previous game.
Well, yeah, there's 8 levels on 7 new maps. You actually go back to the first map again within the same game, but it's just fun, right? I mean, it's all the same stuff. Yeah. It's not groundbreaking, but it's just a fun game.
I couldn't stop dying in that game. I was on the original map out by the farmhouse. It was like a farmhouse. There's a bunch of Germans inside, and I'm hiding in the grass. And those jerks find me. Those damn Nazis find me every time, and I end up on the wrong side of the sniper.
I'm surprised, actually, because you're good at the stealth games. I know you want to talk about Indiana Jones, and I couldn't finish that, and you nailed it, and you loved it.
It sounds like Indiana Jones was just too open world for what you like, Doug.
Well, that's true. Yeah, it's very open world, and I don't like it when there's no clear path to get me from point A to, plot point A to plot point B.
Indiana Jones for me felt like playing a movie, but it was very open world. You can just go off course and go try to find these things, these hidden things. A lot of puzzles in the game, not a lot of head-to-head confrontation. If you've got to fire your gun, every other Nazi on the level is going to hear the gun go off and you're dead immediately. I tried to fire my gun maybe 3 different times. And next thing you know, I've got 12 people on top of me and I'm done.
I just noticed a common theme about both of these games and why we like them. Do you get to mess with Nazis?
Oh, it's so fun. It is so fun.
Nazis.
Yeah. But it's a good time. You will say this about Indiana Jones, Doug, which is the dude that does the voice. So they licensed Harrison Ford's likeness. So it looks like Harrison Ford. And then the dude that does his voice is brilliant.
I was shocked when you told me that. I thought they used AI. They had some voice samplings from Harrison Ford and then just used an AI engine to generate all the dialogue because it is spot on. It's really good.
So good. So Sniper Elite and Indiana Jones, a couple good games. Last week, we were talking about Reacher, and neither you nor I had seen the last episode of Reacher on either the Monday or Wednesday show. So let's finish that up. Did you watch the conclusion?
Yeah, I got, I was 2 episodes behind, so I got to watch 7 and 8 kind of back to back, which was good.
Yeah. The conclusion, the fight with Paulie, really good action sequence.
Takes a long time.
It takes a long time. So Paulie, Doug, is this huge security guard, just this monster.
I'm going to watch this. Do I want to, should I take my headphone out? Do I want to hear this?
No, this will be spoiler free. In episode 1, this isn't giving anything away. In episode 1, there's going to be a fight between Reacher and Paulie. There's got to be, or you're...
Reacher's whatever, in real life, the actor, Adam Richson, is what, 6'3",
it's huge.
265, 6'4", 265.
I think he's 6'13".
6'13".
Yeah.
Now, he's probably 6'2" or 6'3", but he's a big man. Paulie towers over this dude. It's not even it'd be like Doug standing next to a 10U pitcher. You're just such a girth of a man compared to this, little
yes,
kid.
I am.
Which is why Doug likes to stand next to 10-year-olds every chance he gets.
Which is why Doug hangs out with 10-year-olds.
Oh my God.
There's candy in the van.
Oh my God.
No. Favorable comparisons though. Favorable. Look at me. Look how big I am compared to the 10-year-old. Yeah, Reacher season 3, Doug.
So worth it? I should watch it. Sounds like you guys went all the way through it.
Yeah, I liked it. I mean, it's very formulaic now. I think season 1 was still the best. I don't remember much from season 2. This one was also
season
okay,
2
but
sucked.
It's a very...
I didn't think
you
sucked.
get a sense. I don't think any of them sucked. They're very popcorny. Okay, I get to go watch Reacher kick somebody's ass, and it's kind of fun. It's cool.
My favorite part about all of that is not... You guys haven't even mentioned it. It's the dialogue. It's the witty like straight-laced lines that he gets to deliver to make people look stupid.
Ritson said that in an interview that, an action film is an action film is an action film, Doug. And at its core, it can be kind of boring, right? He said 100% of the fun for him was playing that character and being able to look askance or being able to do something that is a hilarious line, or just the way he's able to say the line in a monotone voice. He's like trying to come up with that was the whole fun for him of being in that role.
I believe it.
Versus being 285 and, just ripped.
Jacked and tan.
Yeah.
Because I'm ripped and amazing every day in real life. But when I get to act, I can be smart too.
I know. Reacher, go watch it, or go play Sniper Elite or Indiana Jones or PGA Golf. All right.
I have to belch. Okay. Keep that in, Steve.
No, do not keep that in, Steve.
Fine, I'll do it again. Not scared. There. Nice.
Your turn, Joe.
Nice. It's an after show, Steve.
No, God, no. Please, God, let's go.
Let's have some audio of my prep tomorrow.
Oh, that prep. Yeah. Okay. 3, 2, 1. Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and with all this talk about tariffs and trade wars and consumer buying slowdowns, how do you effectively hedge against all of this volatility? Whether you're new to investing or a seasoned pro, we'll talk about smoothing out your ride in the stock market on today's show. Plus, we'll help stacker Ryan decide between using a diversified portfolio or a single fund that combines the best of all worlds. Why not just keep investing simple? I think I said, why not?
Why not?
Why not?
Your mom asked.
3, 2, 1. Why not just keep investing simple? All that plus
Simply.
Our world. You talk. You go ahead. I'm sure it's good. Go ahead.
No, it's just simply, it'd be an adverb. Simple is an adjective.
Why not just keep investing simply?
Yeah.
Why not keep it simple? Why not keep it simply?
No, that's incorrect.
Simply. Why not keep
simply
it simply?
Is an adverb.
I know. It's investing is the verb. Keep investing.
Investing is a noun clause, I think, in this case. Why not just keep? Keep is the verb. Why not just keep my 3, 2, 1.
Depends on what you're modifying. Are we trying to modify the word investing or the word keep? Are we trying to keep simply or investing simple?
We could just simply keep on investing.
We could just simply do it the way it's written, not worry about it.
We should go back to belching. It's so much more entertaining. 3, 2, 1. I have to do it again, don't I? I'm afraid he's going to jump in again when I do it. 3, 2, 1. Why not just keep investing simple? All that plus our world famous TikTok minute and yours truly's world. No, that's a screwed up sentence.
Yours truly's, yours be truly's.
Yours truly's. You couldn't have waited to edit that one, Josh?
Oh no, I've been put in my place.